You are all familiar looking faces, I think, so I won't start with much about extension and who I am. I'm very glad to see you all again. I will tell you that the assignment for today was a very daunting assignment. Insurance, investing, and retirement planning all in 1 hour. So clearly we're just going to hit a few high points. And there are some things we could, if you all were interested, you could see if you wanted to have further depth on. I'll mention this again just because some of you came in after I mentioned it. The one handout that's a little checklist is an evaluation form for us, for extension, just to find out if, we do this with all our programs, most of our programs at least, to find out if what we have been doing has had any impact, makes any difference for people. So it's if you've attended any of the first 3 sessions, this is session 4 in our series, but the first 3 dealt with basics, financial services, and credit. And if you would just do that, and it's all anonymous, leave it for me, and I'll mix them all up together at the end of the day, and then we'll compile them. So thank you very much for that. Also, because we are covering such a broad range of topics today, the main handout I provided for you is simply a list of resources. Some of the websites there are websites and publications that we'll be looking at that I'll just highlight on the screen, and you'll be able to, they're all on that handout, so you don't have to frantically jot them down. And so there we are. Okay, this session really is about security. And first, it's good, we're going to start with the insurance topic, but you see that it's really about security. All of these things have to do with security, and in the long term, primarily. Risk is something we all have to deal with, right? It's risky to get in the car and come to work in the morning. There are just risks all the time. Some of the risks that we have in life have significant financial consequences, and these are some examples. The fire that could destroy everything, damage to car in an accident, a court judgment saying that you're liable for some damages, and there's a variety of things there. Most of the risks that are up there, with the exception probably of the damage to car, most of those risks are pretty substantial. They're large potential cost. And it's interesting, people manage risk in 5 ways. Some people just say, oh, I don't even want to think about it. We're just going to do nothing and hope for the best. We can also avoid risk, and this is something we all do. We all avoid risk. For example, if it's terrible winter driving conditions outside, we might stay home because we're avoiding the risk on that day. We've decided to not go out. We reduce our risk. When we do go drive, we reduce our risk of injury by putting on a seatbelt, right? That's an example of reducing risk. We reduce our risk by having smoke alarms in our house, which means that we would have more chance of catching a fire early and getting it out, and us getting out of the house. We accept certain risk. We just say, hey, I'm willing to live with that. I know there's a chance that something could go wrong, but I am willing to take that on. And that's different than the first one. The people who do nothing and hope for the best, they also are accepting the risk, but they haven't thought it over. In the case of risk acceptance, we've said, okay, I'm willing to take this. I'm willing to take a risk. And that might mean that I'm choosing not to have insurance on something. I'm choosing not to have insurance that would cover a small theft from my car, which most of us make that choice because we have a deductible that means that we would have to cover if something small was stolen from our car. The other way we manage risk, a systematic way that our society has developed, is through the product of insurance. And insurance is something that we're all familiar with, and you guys work in a medical clinic, so some of you may be extremely familiar with insurance because you may deal with health insurance all the time. I just want to get a couple of terms out here. Risk is simply the possibility that something could go wrong. peril is actually a thing that causes loss. And we use that word peril mostly with homeowners insurance. There are different perils, and you might be insured for certain perils and not insured for other perils. We're usually insured for fire, you know. Most of us, almost nobody, is insured for acts of war. And not almost nobody. Nobody is insured if your house was destroyed because of a war. Insurance policies don't cover that peril. There are different perils: fire, wind damage, you know, those kinds of things. And insurance is the pooling, getting a bunch of people to put their money together into a pool, and whoever has a loss gets to get their benefits paid out of that pool, and people who don't have a loss just sit back and be thankful that they didn't have a loss. To get us thinking, I'd like to have you talk to the person you're sitting near, and you can be in twos or threes or whatever, and just think about these 3 questions and come up with your answer to these 3 questions. And in about 10 minutes, we'll come back, or 15 maybe, we'll come back to these questions, and hopefully you'll be sure of the answers. But right now, just think about, true or false, it's best to avoid insurance policies with features which limit their coverage. Number 2, not being insured for every type of loss is a common mistake. And number 3, since insurance is really complicated, it's important that you have a smart agent who understands all the details. True or false on all those questions? Talk to your partner. Okay. These are the different types. I know that's not very much time, but it's a good way to get us thinking about this and to make sure that we stay awake. It's true, really. This is sort of a dry topic. Insurance is a very dry topic, so we have to engage with it somehow. The types of coverage that we might have are, listed here. We don't have time in this little overview to talk about each of these types of coverage. But these are the different types of coverage that you might need. Not everyone needs all of these kinds of coverage. So, but most people need most of them, but not everyone needs all of them. I want to mention that umbrella liability is relatively new. It covers you for liability, that is the potential of lawsuit damages, beyond what your auto and home insurance would cover. It's a relatively inexpensive product that's relatively new. I want to mention that disability insurance is one of the most overlooked kinds of insurance. People often neglect to have that. They might have life insurance and not think about having disability insurance. Well, I have life insurance. What happens to my family if I die? Well, what happens to your family if you become disabled? That's an even more serious problem financially. And so there. And then I also want to mention that under the homeowners insurance category, renter's insurance is also frequently neglected. And some of you may have young adults in your life. Those are the folks who are most likely to not think about having renter's insurance. And it's, again, quite inexpensive. It can make a huge difference in case of some large or small disaster. How much coverage do you need? Again, to talk about this in depth, you have to talk about each different kind of coverage. But watch out for anyone who is just throwing a simplistic formula at you. You see this most often with life insurance. You should have X times your annual income. It's not that simple. Everybody has different needs, and there are worksheets available to help you figure out what your particular life insurance needs are. There are people who don't need life insurance at all if they don't have dependents. Don't watch out for simplistic formulas, because that is generally not good advice. How much you need varies by your situation, and your coverage needs change over time. Car insurance, as your car gets older, you might say it's not important to have collision insurance anymore. Life insurance, if you don't have dependents, my kids are getting older, one of these days I will dramatically cut back my life insurance coverage. Whatever is minimum, and this we think of with car insurance, is the state minimum requirement for car insurance is woefully inadequate. It won't cover you for any kind of significant accident where you cause damage to somebody else. So that's that minimum liability requirement for the state law is not good enough to meet most people's needs. But and it's critical to understand your coverage. Ask questions, shop around. That's probably the most important thing. People are afraid to ask questions and shop around for insurance because it's complicated. But if you shop around, and if I go to you, you're an insurance agent, and I talk to you and I ask you a bunch of questions, I say, okay, all right, I think I understand. And then I go to you, and you're another insurance agent, and I ask you some more questions, and I remember some things she said, and I say, what about this? And then you tell me some more things. And then I go to you, you're the third insurance agent. By the time I'm done, I've learned a lot from each of these insurance agents, and I may come back to you and say, hey, I've got some more questions, because I learned a couple more things, and does your policy cover X? Shopping around is one of the best ways to be educated, and the best agents will completely understand your need to learn about the product before you make a decision. Policy features that limit your coverage. A deductible, that's the part you have to pay before insurance kicks in. Elimination period or a waiting period, we typically see that with disability insurance. There'll be a 30-day waiting period or a 90-day waiting period before the policy starts paying. Co-payment and co-insurance, that's the portion after the deductible's met, that's the portion that you'll pay, the percentage usually. Policy limit, that's a maximum. It won't pay any more than, like car insurance, this is the most it'll pay. And then benefit coordination clauses are, okay, if you're covered by more than one policy, both policies won't pay you for the same expense. And that's an important thing. Now, the thing to keep in mind about all of those, you know, you might say, well, I don't want my coverage limited. Well, if you want unlimited coverage, you will pay a fortune for that kind of insurance. Actually, there's probably no one out there that would sell it to you. But if you could buy it, it would cost a fortune. And people wouldn't be willing to pay that. So these features that limit coverage, they were created in order to make the insurance system work so that people didn't overuse health care, for example, with co-insurance and deductible, and so that we don't send in claims for every little loss. You know, if my bike is stolen, unless it's a really fancy bike, you know, I'm just gonna face that. I should have locked it up in the garage before I went to bed at night, and I'll have to deal with that, and I won't submit an insurance claim for that. That's one of those risk acceptance things. So policy features that limit coverage actually work in our favor in the big picture, but we do need to understand them, and we do need to know what their implications are and make smart decisions. Thinking, you know, you may have a choice when you buy disability insurance. Do I want a 30-day waiting period, a 60-day waiting period, a 90, 180? And obviously the price for the insurance, the premiums, will be much lower with a 180-day waiting period. But can you manage for those 180 days? That's the thing you have to ask yourself. So you have to weigh the pros and cons and make an informed decision. So to be smart about insurance, you need to have the right kind of coverage, the kinds of coverage you need, but not necessarily every kind of coverage. You need to have the right amount of coverage. You need to adjust your coverage when things change. And then you want to do what you can to keep the cost manageable for yourself. Those are sort of the tasks of insurance coverage. Oh, I'm missing some quotation marks on the left. The large loss principle is a critical aspect of being a smart insurance consumer. And what that means is that you worry about the big stuff, not the small stuff. Not the bike that's stolen off the front porch, but the big stuff, the stuff that could cause you the most damage. These are examples of large losses that you need to be insured for. Massive medical expenses, a court judgment against you, total destruction of your home, death or disability of an earner. Those are the big things. If your insurance coverage doesn't cover, say, a routine visit to the doctor, well, that's a small cost. That's not first priority for insurance. First priority for insurance is the big stuff. So that's a principle just to keep in mind. If you can't afford every kind of insurance or as much insurance as you wish you could, think about focusing your attention on the potential disasters and insuring for them and not worrying so much about the little things. Does that make sense? Okay. These are examples of things that are either considered by experts to be unnecessary or at least low priority. Credit insurance, cancer insurance, all of these things are double indemnity insurance riders. If you die in an accident, your family gets twice as much life insurance. Well, does it make any difference? If you die, you die. If your family needs double, then they need double. If they don't need double, then why pay extra for a double indemnity? You know, I mean, those kinds of things are unimportant, and why pay extra for them? We could talk more about the details on some of those. Some of them are the car rental collision damage. That's, you know, questionable. Maybe you would want that. You need to understand what your auto insurance does before you rent a car. Common errors for insurance: not following the large loss principle. That's really common. People worry about, oh my gosh, but what if somebody stole my TV? You know, and they aren't thinking about that big disastrous loss. It's very helpful to think of insurance as a total package, to make sure that you recognize where you might have overlaps in coverage and that there's no benefit in having overlap. And so if you have various kinds of coverage, make sure they all fit together nicely. Not being familiar with employer-provided and also public insurance benefits, not being familiar and or not taking advantage of what's available there, not having disability, not having enough liability, not making sure you're dealing with a reputable, solvent insurance company, and you can do that through the state insurance commissioner's office, and not shopping around, checking with at least 3 different sources. So questions on those, any of that? That's very quick, but just kind of a overview. True or false? It's best to avoid insurance policies with features which limit their coverage. False, right. And you may or may not have got that in the beginning, but now I think you've gotten it. But I can understand why people might say true to that. And people who aren't very informed would say, oh gosh, no, I don't want anything that would limit my coverage. Yeah, you really do want that, because otherwise it would cost a fortune. Not being insured for every type of loss is a common mistake. Again, that's false. And this one? This one's kind of a trick question. Of course it's good to have a smart insurance agent, but what's even more important is that you understand. So in a certain way, I want to say that question is false. And of course, this is not a proper question. But if you are simply relying on your insurance agent to tell you the right thing to do, that's a mistake. It's important to be a smart insurance consumer. And you need to understand. And if you have an agent who's a good teacher and is good at explaining all the details, that's just as important as having an agent who's smart and understands the details themselves. So, trick question.
I remember that they're a salesperson.
Yeah, that's right. Excellent point. I do want to just mention quickly, health insurance is a changing world these days. COBRA, and again, you guys work in the health field, so COBRA is an opportunity. It's expensive, but it is an opportunity when you lose group coverage to continue it for a period of time. Hawkeye is critical. There's very little reason why any child under 18 in Iowa should be uninsured for health care. Taking advantage of free or low-cost screenings and immunizations available, for example, through public health or other special programs, is a smart move. HIP Iowa is for people who otherwise can't get health insurance. It has options available. But of course, this is changing. And in the next year, we're going to see a lot about that. So, but I just like to have that up there. And then I also like to mention SHIP. And SHIP is on your resource sheet. The Senior Health Insurance Information Program focuses on a lot of issues that affect senior citizens, but because they include long-term care insurance, lots of people want to turn to SHIP even before they get to be Medicare age, because the SHIP has the best information out there about long-term care, Medicare supplement, all of those issues. We don't make publications on those topics because SHIP has free, wonderful publications. So and it's a state agency, completely non-commercial, and they have publications. You can find them online, and you can call, and they'll send you a free copy. So take advantage of SHIP when it applies to you. All right, that's the end of insurance. Do you feel like you're running a race? Okay, and then we move to investing and retirement. And I made questions for investing too. So just take a minute, think about the right answers to these, and we'll come back to them after a bit. For some people, again, all true, false. For some people, avoiding all risk is the best choice when it comes to investing. Number 2, the need for record keeping is a disadvantage of investing in mutual funds. And number 3, over time, small company stocks have averaged the highest investment returns. So just think about what's true, false. Talk to your partner. Going on, just because there's only so much time. First, before we go into investing, we need to stop and think about risk when it comes to investing, shifting from risk related to insurance. When you think about the risks people take, or when you think about risk with your own investments, if you have investments, you worry about losing your money, right? But losing money is sort of ambiguous when it comes to investments. So we need to stop and think about how that can happen and what it means. If the whole market goes in the hole, as we've seen, the whole economy just goes downhill, then that's a risk that many or most or perhaps all stocks out there, for example, would go down in value. So that means that your portfolio would be worth less at that point as well. So the idea that the market could take a downturn. And of course, we also have the possibility that the market will go up. And over time, the market has gone up. But there's what happens if and when it does go down, especially if it goes down for a while in a big way. Business risk is what happens if this particular business that I'm invested in does badly, or a particular industry like pharmaceuticals or the energy industry or tech like computers. What if this particular industry does badly and I have a lot of investments in that industry? Then, there's that possibility that a particular business or a particular industry might do badly, completely irrespective of what the rest of the economy is doing. Interest rate risk, and that involves if I invest in something, if I put my money in something that's going to pay a certain amount of interest, and then interest rates go up, number 1, I missed that opportunity. Number 2, my particular investment is no longer worth as much because it only pays 3% interest, and now people could get 4% interest. So why would they want to buy my investment? Inflation risk. That means the possibility that we might not be able to buy as much with this money 10 years from now as we can buy with it now. So basically what that means is that there's a risk that a particular investment might not keep up with inflation, in which case we've actually lost money, right? Because if it hasn't grown at least as much as inflation, then we've lost money. It looks like on paper like we've gained money, but we've lost buying power. So that's a risk. Reinvestment risk. Okay, if this investment reaches maturity and I have to take the money out and reinvest it somewhere else, well, what if I don't have what if there's no good place to put it right now? People have CDs coming due, and now they want to, maybe 5-year CDs, and they want to reinvest them, and now they have to reinvest them at a much lower interest rate. That's an example. There's a couple other kinds of risk at least that aren't on here, even currency risk, liquidity risk. But the point of showing you this slide is not to make you, all investment wonks, but just to help you see that there's a lot of different kinds of risks. And that first statement, all investments involve some type of risk. People think about, well, there's a chance I might lose my money. My money might not be there later when I want it. So maybe they then put their investment in a CD with an FDIC insured institution. So they don't have that because it's insured by the full faith and credit of the US government. So they don't have that market risk or business risk. It's going to be worth less later. But they have inflation risk because there's a really good chance that it won't keep up with inflation. So, I mean, it's almost a certainty that it won't keep up with inflation. So the reality is that we don't get to say that there's no, we don't get to choose an investment with no risk. We have to pick and choose which risks we're willing to take and balance them, and understand those risks. So that might tell you the answer to one of the questions. Your investment goals, any investment that you choose, you might choose for one of these goals. And you need to know what you're investing for. And you might make different investment choices depending on whether you're investing for retirement, which is 30 years away, or for my kids' college, which is 10 years away, or if I'm putting away the money that I'm going to use for a down payment on a house 2 years from now. You know, whatever your particular goal is, you have to be thinking about that before you decide where to invest that money. Any investment is going to be appropriate for different investment objectives. One objective is growth. In other words, this money is going to sit here. Right now it's only worth this much, but I'm going to let it sit there, and I'm hoping that in 10 years it'll be worth this much. It'll be worth more. One investment objective is income. I want to put this money in here, and because it's sitting there, I want to be having them send me money every month or every quarter. Interest or dividends, you know, would be the types of income that you could get. You can have some investments that are good for a combination of growth and income. You might have stocks that also pay dividends. So I'm hoping that it will be worth more 10 years from now, but I also am expecting that it's going to pay me some dividends throughout its time. And you can have some investments that are designed, their primary purpose is to preserve capital. That's the FDIC insured stuff and other stuff that's really safe. It means there's very little chance that my money won't be there, almost no chance that my money won't be there when I need it to pay for to buy my house 2 years from now. And then some funds also have tax savings as a goal, or some investments also provide a benefit by way of tax savings, which that can be coupled with some of those others. In general, as we look at investments, we can divide them into two major categories: ownership. And basically, ownership is associated with owning stocks. But you can also, you have ownership if you own a house. You could have ownership if you have a business, or if you invested, maybe you and your sibling are partners in a business, you would have half ownership in that business. Apart from those two examples, and if you own great works of art, you know, which I'm sure you all have in your living rooms, a Picasso or two. Yeah. If you own great works of art, then that would be another example of ownership. But for most people, apart from their home, the main ownership investments they have relate to stocks, which is not owning a whole business, but owning a little teeny share in a business. And the thing with ownership is that whatever it is you own, the value is going to go up and down depending on what's going on in the economy and in that business. And we've seen that. We've seen that with homes in the last 5 years. People who expected their house to just keep growing in value, instead it went down. Less here in Iowa than in some parts of the country. And we also see that, of course, with stocks and businesses. Over the long term, though, we have a potentially higher return with ownership investments. The other category is loanership. What that means is that we've made a loan to somebody and they are agreeing to pay us interest on the money that we loaned them. And that interest rate is preset. Depending on the investment, it might fluctuate too. But you're pretty well guaranteed that you'll get your original principal back when the term of the loan is over. So that usually is associated with bonds. Even things like CDs and savings accounts would be considered loans, essentially. But bonds are the main thing. So talking about stocks, it's a security, as we discussed. It's a part ownership in a corporation. And there are two ways to make money with stocks. I guess I've already kind of talked about this. The one is that, okay, it's worth this much now, but I'm hoping that next year it'll be worth more, and the year after that it'll be worth more, and then the year after that it'll be worth more and more. And that is the root of what capital gains are. And just it's vocabulary. Part of investing is just vocabulary. Capital gains are whatever, if it's worth more now when you sell it than it was when you bought it, then the profit you made, that's your capital gains. And that is a phrase that you need to understand taxes. And we hear about it all the time. Congress debates capital gains rates and that kind of thing. So it's just, I wanted to point that out, that if it's worth more in the future, then that involves capital gain. It can also involve capital loss if it's worth less in the future. And then dividends, that's kind of like the corporation paying out a share of the profits. Well, we had a great year, so we're going to send dividends to all of our owners, because the owners should get a share of the profits too. Some stocks pay dividends. They set out and they say from the beginning, we plan to pay dividends. Other stocks say, you know, we're really working on growing our company. We don't expect to be paying out profits to our owners, so don't expect it. And you usually can have a pretty good idea what to expect if you buy a particular stock. Is this stock planning to pay dividends or is it not? And that's a piece of understanding if you buy stocks. Bonds, they're IOUs. They come from corporations, but they also come from governments. And the federal government, municipal government, we have bonds, school bonds sometimes, school districts issue bonds. They are often used to cushion a stock portfolio because they tend to operate opposite of stocks. Not always, but over time, if stocks go down, bonds might not go down. In fact, they might go up, and vice versa. They generally are used for more, not so much for your long-term goals, but more your short-term or intermediate-term goals. You wouldn't put, if you're retiring 30 years from now, you wouldn't put your retirement portfolio in bonds typically, or at least only a small portion of it. Generally, a bond is issued for $1,000, and then that's the most typical. You can buy them in units of $1,000. Some will pay interest semi-annually, or maybe quarterly or annually. Others, it's a $1,000 bond, and maybe it's a 10-year bond, but when you buy it, you only pay $600 for it. And they don't pay you interest over those 10 years, but then when 10 years is up and you cash it in, you get $1,000. We're familiar with that because that's how savings bonds have worked for years. But zero coupon bonds fit that way too. Mutual funds, the thing with stocks and bonds, of course, is that most of us are amateurs when it comes to investing. And most of us don't have a whole lot of money. So if we have $1,000 or even $10,000, how can we, do we want to put all that in one company? That's a little scary. Mutual funds are kind of like insurance. It's a bunch of people pooling their investments, just like insurance is a bunch of people pooling their risks. So it's a portfolio. It's a bunch of different stocks, or it's a bunch of different bonds, or it could be other things too. There are mutual funds that invest in real estate. But it's a portfolio of a bunch of different things, not just one thing. And a lot of people own it together. So altogether, even though I only have 1,000 or maybe 10,000 to invest, a lot of other people are in there too. So the portfolio, the fund may have millions or even $1 billion to invest. So they can really invest in a lot of different things. And being diversified is a big plus, because then if one business does badly, that's only a portion of what I own, and other businesses will have done well. And so diversification is a critical piece. It reduces your risk. And it's managed by professionals. Professionals spend their life. This is their job, to study stocks and securities. And so those are some of the things to know about mutual funds. It's important to understand all this because most of us start investing with mutual funds. That's not everybody, but most people start with mutual funds. The advantages are that full-time management. I'm an amateur. Those guys know what they're doing. They should be able to make smarter decisions, and they can collect data and understand what's going on with different companies so they can figure out when it's the right time to buy or sell. And of course, we've talked about diversification. That's huge. That's a major advantage of diversification. You usually don't need much. You don't need much of investment to get started. You might not even need, if you're setting it up as a payroll withdrawal, you might not need a lump sum at all. They might be willing to start you out with a $50 a month, zero minimum deposit, initial deposit, and $50 a month or $100 a month if you're going to be investing steadily. So you can start small. Whereas if you want to buy stocks, you're going to need a chunk of money just to buy a few stocks to start out. You can generally get that money anytime. There's no guarantee how much, it might be worth more or less when you want to sell it, but you will almost certainly be able to sell that investment if you need it. Convenience, automatic convenience, meaning somebody else is doing the work. And somebody else is doing the record keeping. Somebody else is keeping track of the tax issues. Somebody else is keeping all of that kind of stuff. Automatic investment and withdrawal plans are available. That's another part of the convenience. Monitoring is easy. If you have a portfolio of a bunch of different stocks or a bunch of different investments, then you have to keep your eye on all of those different investments to know how your whole portfolio is doing. If you've just got a mutual fund, then you only have to watch the performance of that fund. It's only one thing to watch instead of 20 or 50 different things to watch. So that makes monitoring easier. So an advantage of mutual funds is the fact that they do a lot of the record keeping for you. Record keeping's a lot easier with mutual funds. Disadvantages?
I have the trouble with the ready access to your funds.
Uh-huh.
Because a lot of times if you go to pull something out of your mutual fund, you get dinged.
There's fees. Mm-hmm. Yes.
I mean,
Yeah.
you can get it.
Exactly. I'm glad you mentioned fees because I should have mentioned that too. Yes, fees and maybe taxes, depending on the nature of the investment. But yeah, ready access, generally you're going to be able to get it, but not without a cost. Yeah. Depending on, there'll almost always be some kind of transaction fee, but depending on the nature of the fund, you might have there's different kinds of loads in mutual funds, so which we don't have time for today, but that's a good point to bring up. Disadvantages, they do tend to follow the market. So, some people might see that as a disadvantage, so that if the market goes down, there's a pretty good chance that your mutual fund will be worth less also. You certainly don't have a guaranteed rate of return because it's not like it's not fixed, guaranteed in writing. You have to just see what's going to happen. You can sometimes get a 1099 form at the end of the year that says you have some taxable income, even if they never sent you any money at all, because the fund had income. So that's, again, beyond today's thing. And fees. You've got to pay the salary of those professional managers, right? And they've got to pay for the paperwork and the computers where they keep your record keeping. So there's always costs. You're paying somebody else to do that. But given the trade-off, a lot of people still decide it's absolutely worth it compared to their ability to do it on their own. Mutual funds are labeled. These are just some of the labels. They can be made up mostly of stocks. They can be made up mostly of bonds. They could be a mix. They can be money market funds, which is quite conservative and means that they're putting their money into treasury securities and other things that are very low risk. It'll always have one of these four investments: growth, income, or a combination of growth and income, or preservation of capital. Those are the same investment goals that we talked about at the beginning. Not tax savings, because this statement says every fund has one of these four objectives. Some of these will also have tax savings as part of their objective. If you want to buy individual stocks instead of mutual funds, You just have to know that you're going to have to spend time and you're going to have to study. You will have some transaction costs every time you buy and sell. Even though it's not a mutual fund with fees, you'll have a transaction cost. And you have it's much harder to be adequately diversified. So those are things to understand. And some people choose to put, they've got most of their money in mutual funds, but I just want to try doing some myself. So they've got some extra money, that's sort of extra money, and they say, I'm going to pick, a few different stocks, and I'm just going to put some money in those and just see what happens. And usually, if they're not professional investors, they are doing that knowing that they might make a mistake. So this isn't their core, most critical money that they're doing that with. It is okay to buy individual stocks, though. It's perfectly safe if you're an expert, or if you have enough money to buy at least 10 or 20 different stocks to get some diversification. Bonds, an individual bond will give you this regular income stream. You've got the guarantee that you're going to get your principal back. It's almost a guarantee. There is the chance that the lender, corporation, whatever, might go bankrupt, but that very rarely happens. And the ability to set them up so you've got some that come due at different times, which means you can have income coming in on a regular basis. The mutual funds of bonds have obviously much greater diversification, monthly dividends, low minimum to purchase, and the ability to sell. These are harder to sell. A really critical thing with investing is to make sure you have reasonable expectations. I'm going to show you a chart that is the average annual return of each of these investments for 86 years. Small company stocks average 12%, 12.1. Large company stocks average just under 10%. Long-term corporate bonds, 5.9%. Long-term government bonds, 5.5%. So much smaller. Treasury bills, 3.6%. And over that time, inflation was 3%. So as you invest money, you need to be reasonable in thinking about what to expect. Otherwise, you won't get the results you are hoping for. That's, of course, past performance is no guarantee of future returns, but that is the long-term history over a very long period of time. Within investing, we also have this important process called asset allocation. It's a smart process for everybody to take, to think about, and you see the little chart there that's a pie, to think about what portion do I want in stocks, bonds, and cash, and then within stocks, how do I want to divide that? Within bonds, do I want to divide that? And think that over systematically based on what your objectives are. If this is my college fund, how much of it do I want in stocks versus how much do I want in bonds? If this is my retirement fund, that might be different. Your choices are going to be dependent on how old you are, how tolerant you are to risk, and what's your time frame for investing. And there is, on your resource sheet, there is a little risk tolerance quiz that's there. You can check it out online to help you get a sense of what, it's not the only one out there in the world, but it's one mentioned. For long-term investing, in general, people will put 40 to 90% in stocks. You see that's a wide range, and that depends on their risk tolerance. But if it's a long-term goal, you should have some substantial portion in stocks, because otherwise you won't keep up with inflation. For long-term investing, you'd have between 5 and 50% in bonds usually, and you'd have 10 to 25% in cash, sometimes even less than 10. For retirement, conservative investors, and this is an old rule of thumb, they take 100 minus their age and they put that percent in stock. So if I'm 50, then I would put 50% of my retirement investment in stock. If I'm 65, I would put 35% of my retirement investment in stock. Now, as people have gotten to be living longer and longer, folks have said that's too conservative. So more aggressive investors would take 115 minus their age. This is just a rule of thumb. It's not necessarily gospel. It's not necessarily this is what you should do. But it's a rule that people use, and it's something that's useful to be aware of as you think about your investment choices. We do have data that says, okay, if some people, if we could imagine every possible combination of investments, 90% stock, 10% cash, 80% stock, 10% bonds, 10% cash, 70% stock, 20% bonds, 10% cash. And you could imagine every possible, and because we have computers now, people have done those kind of analyses using real data from real past returns and over time, ups and downs, taking into account all of that. Knowing, of course, that whenever they do these analyses, they're using past data. We don't know what the future holds, but the past is at least some indication. And what those analyses have shown is that the more stock you have in the mix, you have a much better chance of having high average annual returns. But there's also a much greater chance, I mean, it's almost a certainty, that you'll have more ups and downs. So the best year and the worst year will be further apart if you have more stocks. So that's just something to keep in mind. They've been able to do these amazing simulations now because of computers. And it really does show that for long-term stuff, we need to have investments in stock. But we just need to be prepared for the ups and downs. And then if we've set, okay, I want 60, 30, 10. That's the asset allocation I want. And if stocks are doing well, then my stocks will grow and they'll be worth more. And suddenly they might be 70% of my portfolio. And all of a sudden I've got 70, 25, 5. Well, but I said I wanted 60, 30, 10. So every once in a while we need to stop and take a look at, okay, what's my asset allocation now? Because things grow differently. And so rebalancing is a good idea, and it's easy to ignore. I mean, it's all too easy to let this slip. You can rebalance in two different ways. You can take, okay, I've got all this stock, and I'm just going to sell some of it and use this to buy more bonds. Or I can leave that much stock, but all my new investment that I'm putting in every month, I can just buy bonds for a while. Instead of putting it equally, I can only buy bonds for 6 months or a year, and then I'll get myself back to my asset allocation I want. Don't be worrying about rebalancing if you're 1% off or 3% off. That's going to fluctuate over time anyway. So if I said I wanted 60, 40, 10, and I'm at 59, no, 60, 30, 10, 59, 31, 10, let it be, because that'll adjust over time anyway. But if you're 5 or 10% off, then it's time to rebalance. So these are just some general principles about investing. Diversify. When you do get dividends, when you do get earnings from your investment, if you're investing for the long term, then those should be reinvested. That's really important. Buy what you know, understand what you're investing in. If you don't already know, then get to know what you're buying. Buy and hold, and dollar cost averaging is a valuable strategy that I don't have time to explain, I'm sorry. Key ideas, start now. Remember that stocks have outperformed everything else over time. Understand what you can live with. You want to be able to sleep at night. You don't want to be terrified about your investments. Keep your goals in mind and recognize that your investment choices will be different depending on what your goals are. And keep in mind that the biggest risk is to not invest, because inflation is a huge enemy. Mutual funds are great tools for beginners. Take the long view and hold on. Somebody wrote that. Okay, for some people, avoiding all risk is the best choice. False. It's impossible. Nobody can avoid all risk. You're going to take risk no matter what you invest in. Or if you don't invest, you're also taking risk. The need for record keeping is a disadvantage of investing in mutual funds. Actually, it's just the opposite. With mutual funds, you have a lower need for record keeping. So that one's false. And finally, this one's true. Over time, small company stocks have averaged the highest investment returns. So I'll bet you a bunch of you got those right. Choose a financial professional. The main thing I want to say is just shop around. And we did give you the one little handout that has some ideas on that. Investing for college. We're going to talk next about retirement, but I wanted to say one slide about college. 529 plans, they're named after the section of the law that created them. 529 plans offer tax-free growth, and it's tax-free on federal and state. Plus, whatever you put in, you get a state tax deduction. And the contributor, whoever puts the money in, they remain the owner of the funds, and they control the funds. Whereas if you have some money that's put into a gift to minors account, you're saving for a child's college, when they turn 18, then it's theirs, and they can do what they want with it. So that's an advantage. College Savings Iowa is Iowa's plan. On your handout, there's also a website that shows the plans of all different states, but you'll only get the state tax deduction if you live in the state that sponsors the plan. Expenses paid with funds from tax-advantaged accounts, including 529 plans and also Coverdell accounts or some others. If you pay expenses with those funds, they are not eligible for the education tax credits. And that's an important thing to keep in mind. So what you want to do is not pay tuition and books with your 529 funds. You can pay room and board with your 529 funds and use different money to pay tuition and books, because those are the expenses that are eligible for education credits. And then you can have the bottom line is, if you put all your money into these tax advantage plans and you're saving for college for someone, then you won't be able to be able to take advantage of the education tax credits if for any expenses you use that money. So having some that you pay, having a mix is a good idea. When 529 plans were created, the tax credits were much smaller, and they've gotten much bigger, at least for now. Retirement. Oh, only 5 minutes. You all have different retirement dreams. Starting early is good, and nobody here is 22, I'm pretty sure. But I just have this example of how starting early is good. We have investor A put in $2,000 a year starting at age 22, and they did it for 5 years and then they stopped. Investor B didn't start at 22, they waited 10 years, started at 32, invested $2,000 a year every year till they retired, 35 years. Investor C started at 22 and kept going. Who's going to do best? Who's going to have the best results when they turn 65? C. That's a no-brainer, right? It's clear. And by the way, the results I'm going to show you are based on a 10% annual return, which seems in this economy a little optimistic. Over time, over a 35-year time period, that might still not be unrealistic. So when they turn 66, after those 35 years, the one who invested $2,000 a year for 5 years will have $607,000 because they invested it and then they left it there. The one who didn't start till 32 and then went for 35 years will have $596,000. And C will have $1.5 million, as you predicted. C is obviously the best. But this is a little surprising, isn't it? This guy only put $10,000 in. This guy put in $70,000 and yet has less to show for it than this guy. It's because of the time. That had more time to sit there and grow. It's an example of why starting early pays off. And we do have a publication that this example is printed in, and on your handout there's there's a link that shows you how to find that publication. None of us is 22. We can't go back and be 22 over again. And it's important to know that no matter how old we are, there's benefit in working towards retirement. $2,000 a year for 5 years if we earn 6%, which depending these days, that could be a stretch, that'll give us an extra $11,000. And that's, you know, it's not enough to retire on, but it's extra money. If we did that for 10 years, it'd be $26,000. If we did $3,000 a year, it'd be $16,900, almost 17, or for 10 years, it'd be $39,500. So even in 5 or 10 years, you can do some things that will help you. And if you earned an 8% return, then the numbers would be bigger. And the higher return is more valuable when you're going for a longer time with more money. None of those numbers are enough to retire on by themselves, but they're extra that would help. It could be the money that buys a new roof for the house when it comes time that you need the new roof for the house. It could be the money you use for that trip to Europe. It could be, it's extra security. It could be money that you just don't touch until you're 90 and you really need money for something. So it's never too early. These are the different sources of retirement income for most people: Social Security, employer pensions, and also employer-sponsored plans. Our personal savings and investments, which could be through IRAs, could be through taxable investment accounts, could be through real estate that we might plan to get rental income from, or assets that we've bought that we plan to sell. That's the Picassos in our living room. And another source of retirement income for many people is earnings from employment. Just a little bit about Social Security. What you get from Social Security is based on your top 35 years of earnings. Okay? So if you worked only 25 years, then there'll be 10 zeros in there, and that's all averaged in. So working more years can give you more years, it can give you a better average, and that average is what they base your Social Security payout on. You must have worked for at least 10 years, 40 quarters. Or you can be married to someone for 10 years and draw on their record. So if you know somebody who's thinking about getting divorced and it's been 9 years, you know, it can be pretty smart to not have that divorce finalized till after 10 years. And it doesn't hurt the spouse or any future spouses of that spouse. If you were married to that person for 10 years, you could draw on their record. If you draw on their record, you only get half of what they would get. But for many people, for women, 64% of women do better by taking half of the spouse's benefit than they do by taking their own, which is kind of sad, really. Full retirement age is increasing to 67. Earnings limits, if you start drawing Social Security before your full retirement age, then you will have a limit on how much you can earn, or else you'll have to pay back Social Security. There's no time. I completely didn't get the time. Do you want me to keep going? Or do you, you may need to leave. I do want to show you a couple things. I was going to explain the difference between those kinds of pensions. Inflation. If we can live on $30,000 today, in 35 years, if inflation is only 3%, we'd need $85,000 to buy the same stuff. You've got to plan on inflation, especially because we tend to live so long these days. If inflation was 4%, we'd need $118,000. I'm going to skip this one. People aren't saving enough. That's just a reality that you need to be ready for. And if you're planning on Social Security, you know, Social Security is not going to provide everything you need for most people. There's some key questions you need to consider as you're doing your retirement planning. How long will you live? What age are you planning to retire? Those kinds of questions. And to factor all those questions in, there's this tool, and it's on your resource sheet. It's an interactive retirement calculator, choosetosave.org/ballpark. And it is non-commercial. It's created and maintained by a nonprofit consortium of organizations. And it allows you to go in and say, okay, I am this old now. I have this much money saved so far. I think this is going to be my Social Security benefit. This is how much in today's dollars I would want to live on. This is how much I'm putting away. This is what investment return I expect to, and it'll run the calculations for it and print it out for you too. I mean, it'll show you on the screen, but you can also print it out. And the reason I say that is because you can print it out and then you can go back in and say, okay, but what if inflation was 5%? Or what if my investment returns only were 7% instead of 8%? Or what if I worked an extra 2 years? So you can run different calculations to help you make the best decisions you can. And that's a really wonderful tool. So I'd like to encourage you to think about what you will do, because we talked about so many things today. You might leave here and say, I'm going to go home and take another look at my insurance coverage because I'm just not real clear on what my policy covers and what it doesn't cover. You might, or look for ways to reduce premiums. You might go home and do a net worth statement just to see your assets and liabilities and see, you know, where you stand. You might review your asset allocation, or you might calculate your retirement savings needs. And research does show that people who have figured out their retirement projections, who've at least made an attempt to get a handle on that, using a tool like the ballpark thing, they do a better job of getting prepared for retirement because they've done that. So I'd encourage you all to decide to take at least one step after this workshop. All right, I'm sorry, but time's up.